Today's educational webcast titled Let's Review Roth 401k and Traditional 401k and take a look at steps on Roth conversion options. Before we get started, the disclosure, of course, is this is educational only. So we're not giving specific advice to your planning situation. No specific advice on investments or any steps you should take personally. This is all education only. Traditional 401k, probably many of you listening, this is, how you've contributed, right? An example, $200 a week from your paycheck, you put in the traditional 401k, you get a tax break, if you will. So let's assume you make $1,000 a week gross and you put in $200 a week in the traditional 401k, you're taxed on $800. So you likely saved anywhere from $50 to $60 a week in taxes over the course of the year, call it $3,000. However, the trade-off is when you retire, when you use the money in a traditional 401k, because all the contributions went in pre-tax, and that is the company match. In this case, Dennis K. Burke has a nice match. They put in every paycheck, and if the company happened to do a profit sharing, that also would be a pre-tax contribution. So traditional 401k, your money's gone in pre-tax. If there's a match, that's pre-tax because it's an expense for the company. And if there's profit sharing, that's an expense for the company. So in a way, pre-tax as well. So translation, when you take money out of a traditional 401k, every dollar coming out is taxed. There's also the minimum retirement distribution rule on a traditional 401k where age 73, if you're not still working, then you have to take out a minimum calculation, which we do a fair amount of these. It would just be a mortality, an expense calculation on an IRS table. But the issue with traditional 401k is everything coming out is taxed. Secondly, you have to take out a minimum amount at age 73. You can roll over your money if you leave the company to an IRA, and we will talk a little further on in our review about conversion options. Contrast the traditional with the Roth 401k. As you can probably deduce here, everything in a Roth 401k is post-tax. So my example, if you make $1,000 a week, you're going to get taxed, your Social Security tax, your federal, your state income, FUTA, federal unemployment, state unemployment, any other withholding that comes out, maybe health plan, dental plan. Once that has all been taxed, then your Roth 401k will come out as well. So the example of the $200 I've been using a week going into your company retirement, if you did a Roth K, the $200 would go in just like traditional, but it would go in post-tax, not pre-tax. Why would you do that or consider it? Because everything that comes out of the Roth 401k in a Roth IRA, everything that comes out, all the gains, all the earnings will be tax-free. So that could be a very large part of your retirement income planning if you have more of your retirement savings when it's distributed being tax-free. There's also no minimum age of withdrawal on a Roth 401k. This changed. Prior to 1/1/2024, you did have to take a minimum amount out of the Roth 401k, similar to traditional. The workaround was you did a Roth 401k rollover to a Roth IRA on your own outside the plan. Now, because of Secure 2.0, you don't have to worry about that minimum retirement distribution of a Roth 401k. So that changed. However, most people, I would suggest, do put the Roth 401k together with their Roth IRA. Just easier to manage and easier to keep an eye on. Again, you can roll over money from a Roth 401k to a Roth IRA, no tax treatment. Let's take a quick look at an example. A couple employees here. We're calling the first guy John, the second employee Sarah. How does a Roth 401k affect your paycheck? I was getting in a little bit of this. Well, let's assume John makes $50,000. Tax rate is 22%. He wants to put $400 a month in a traditional 401k. That's only going to affect his take home based on this tax bracket by $312. Because again, he got a write-off. On the other hand, if he does the $400 in a Roth 401k, that affects his paycheck dollar for dollar by the $400 because again, it's post-tax. Sarah makes a little more money. She decides she wants to put in some additional money and she puts $1,625 a month in. So in a traditional 401k, that saves her almost $400 a month in taxes, or $5,000 a year. However, she says, I like this Roth 401k idea. I guess I've got to adopt the philosophy, pay me now or pay me later, meaning I'm going to give up the tax write-off. But down the road, when I take the money out, all the earnings are tax-free. I don't have to worry about a minimum age to take money out. And that will really help your income tax planning in retirement, which we'll get into a little. So her example, again, a little more dramatic because she's putting a little more money in, but same example. She gets a write-off on the traditional. On the Roth, it's going to affect her take-home dollar for dollar. So moving in a little more into the definitions, this is a very general overview of the difference in the distribution. If you have, assuming at a certain age, let's call it 65, seems to be a common age for people to think about on the retirement planning. If you have a Roth 401k balance, in this case, we're saying 185,000, and you have a pre-tax 401k, 185,000. So same money at retirement. We're giving this example. I didn't do, the quote unquote deep analysis, and Anthony didn't either, because it would be sort of a busy slide. But you're right, if you're thinking about it, you would have to take into account kind of the tax savings you've had, in the pre-tax funding. So what I'm thinking about, just a general example, let's say you contributed over the last 20 years, $9,000 a year to basically get to about 180 grand or so. So every year you saved, I'm going to use a round number, 20% on the 9 grand you put in the pre-tax. So that was about $1,800. So over the course of 20 years, very general, you would have saved 1,800 times 20 years, 36,000 in taxes. So very general, but if you wanted to add that, if you would, to the bottom line here, because what we're trying to demonstrate is the same balance in a Roth K and a traditional are taxed very differently when you take the money out, right? Nothing is taxed on the Roth 401k earnings. Everything is taxed on the distribution on the pre-tax. So you come down to the bottom, you say, all right, the Roth will be free and clear, if you will. The pre-tax traditional 401k get taxed federal, we assume state of Massachusetts. But if you want to take my example to add back in the tax savings, if you add 36,000 to 138, that's 174. You're still $11,000 or $12,000 ahead on the Roth 401k versus pre-tax. Again, that's a very general example. If you want to see a deeper analysis of this, please, let me or Anthony know. We can kind of get a little better into the details based on your exact salary, maybe your joint salary, etc. But I still think the benefits of the Roth 401k will outweigh, the pre-tax 401k. This is a very, general statement. Let's kind of look on the next slide here. When you're thinking of choosing a Roth or traditional, I'm thinking of my own kids. Maggie's 28, Scott's 26. As a rule, I would suggest to them put it all in a Roth 401k, where they're working. Now, there may be some discussion that they have because they're both single taxpayers still. Geez, I don't have too many write-offs. I don't own property yet. I don't have any depreciation or maybe an investment property. So I'd like a little bit of a write-off. But I think all of us would agree at some point the tax person is going to come calling, meaning we've just gone through this significant pandemic, right? Where by all estimates, $4 trillion a deficit in the US and growing. The pandemic, there was a lot of deferrals, the college loan payments, there was the PPP for businesses, and that was forgiven, didn't have to pay it back. So, and there's an awful lot of printing, if you will, of money from the federal government to continue to raise capital for the budget. So I think at some point, tax rates will go up. I think that's a fair assumption. They're some of the lowest tax rates we've had probably since the 70s on the federal side. So that also drives the discussion. What do you want to do? If you do the pre-tax Traditional 401k, as we've talked, you're going to get taxed on everything coming out. Yes, you have the tax savings ongoing. If you do the Roth 401k, it's all post-tax, so you don't get a write-off. But down the road, when you take it out, there'll be a significant, I believe, retirement income planning advantage because all the earnings on the Roth K will be tax-free. So take a look at your own tax return, the front of the 1040. What did you pay in federal income tax? State income tax. You kind of have to think this through a little bit. If you're a joint filer, maybe one idea is if you're both earning the salary, one of you does the Roth K, the other does the traditional. And maybe you still need some tax write-offs for your own planning. The last bullet, are you going to retire to a state without income tax? A lot of people don't know that right yet, even if you are closer to, say the day of using your money. And the quick comment on that as well, people say, well, I'm 60, I'm 50, I haven't done the Roth K yet, I think I'm late. I would encourage you to rethink that. I don't think you're ever too late to start accumulating more retirement savings that will come out ultimately tax-free on the earnings. You've got to wait at least 5 years. You have to have the account open 5 years and be at least age 59 and a half. So again, I wouldn't necessarily say the age dictates doing the Roth 401k or the traditional. Certainly, I think the younger ages, just out of high school, college, graduate school, just working career, pretty clear that Roth 401k should far out benefit the traditional over the next 25, 30 years, because I think the brackets are going up. So let's continue to look at the differences. This slide starts to clarify a little better for people, because a lot of people say, well, I have a Roth IRA. Isn't that enough? I mean, the Roth 401k. Well, you can't have both. Just understand that you can't have a Roth 401k and a traditional 401k exceed $23,000 if you're under age 50 in 2024. You can't have a Roth 401k traditional combined exceed $30,500 in 2024 if you're over age 50. You can, however, continue to do, in addition to the Roth 401k, a Roth IRA, as long as your adjusted gross income, and we'll get to the ranges, satisfy the IRS. So a Roth IRA you could do in addition to the Roth 401k. Contributions $7,000 if you're under 50, $1,000 if you're additional if you're over 50, and this is for each earner in the house. Something to think about. I remember starting my own kids when they started working in high school and they got some earned income. You can do a Roth IRA, for them based on their earned income. Getting started early and not a bad idea. So as we kind of go through the comparisons here, the Roth 401k obviously is through your work plan. If you do a Roth IRA, there's obviously no match, but that's your own account. Yeah, maybe a little fewer on the investment options at work with a Roth 401k, but obviously in the Roth IRA, you can do a brokerage account, Schwab, Vanguard, Fidelity, etc. Roth 401k, we need to update this based on the new Secure 2.0, Anthony. The minimum distribution in the Roth 401k, you don't have to worry about that anymore. So we did this prior to that change, so just we'll update that. But good news. So if you have a Roth 401k, you're still working, or maybe you left your money in the company plan, you don't have to take it out at 73 like you used to. However, the traditional 401k, you still have to take it out at 73. Roth IRA, there's no withdrawal requirements. A little more comparison. A Roth 401k may allow in-service withdrawal or hardship. Some record keepers are tough about this. They don't allow the in-service or the hardship to occur inside a retirement plan or a Roth 401k. They do allow it on a traditional. Double check in your case with John Hancock on their definition. Roth IRA, anytime. You can withdraw your own contributions, which goes without saying, but the earnings, you have to wait 5 years in a Roth IRA, and you got to be at least age 59 and a half not to have a 10% penalty on the earnings. But again, your own contribution, your own basis in a Roth IRA, anytime contribution can be made. I talked a little bit about no income limits inside a qualified plan, a company retirement plan like a Core Concepts to fund a Roth. There are limitations, and here they are on a Roth IRA. Individually, if your AGI this year, 2024, is over 161,000, you can't do a Roth IRA. Jointly, over 240,000. Again, take a look at the front of your 1040. AGI is very different than gross Medicare wages, right? So, look at your, it's about 2/3 of the way down on the 1040. You'll see a line, modified adjusted gross income. Look at that number and then match it up to the tax code. A little footnote to that discussion, and I encourage you to talk to your own planner. There is a method by which it's called, it's not listed in the code, but a backdoor Roth IRA. If your AGI is too high, you potentially could fund a conventional non-deductible IRA and then convert it on a tax-free basis to a Roth. Again, bring that up with your own advisor, but that's one little footnote to the Roth IRA funding if your AGI is too high. Most employers are offering the Roth 401k as part of your plan. You have that at Core Concepts. Again, a Roth IRA, as long as you have earned income, you can fund a Roth. Started actually Roth IRAs on my kids years ago. They started to have some earned income in high school with jobs. You can fund a Roth IRA, just an idea. You can roll over Roth 401k to another Roth IRA. In a Roth IRA, you can transfer around at any time. If you want to go from the Schwab brokerage to the Fidelity brokerage to Vanguard, whatever you'd like to do. So moving into the discussion a little more, just to give you the detail on the graphs, the Roth IRA, you're not eligible to do the Roth IRA as a single payer if your adjusted gross is over 161 grand and married over 240,000. However, you can do the full contribution. You can see the line items there. If you're single under 146, again, adjusted gross income, not W-2, and married under 230,000. There are some partial contributions as well in between 146 and 161 and 230 and 240. And again, just reiterating the contributions this year in 2024 for the Roth IRAs or accounts, you can do 7,000 if you're under age 50 and another 1,000 makeup, if you will, if you're over age 50. And the 401k has the same base 23,000, just like the Roth K, and an additional 7,500 if you're over age 50. So these graphs are, on the IRS website, which we've disclosed at the end. So, please talk to your own accountant. You have up until your 4/15/2024 to fund a Roth IRA, not a Roth 401k. That's based on the calendar year of your company. So something to think about. Roth IRA conversion. This gets obviously very specific to, your tax planning, but it is becoming a very popular topic. Are people necessarily taking advantage of this option right away? No, because it's a big tax question. I'm going to use 100,000 example. So you have 100,000 in your traditional 401k balance. You've been thinking about this Roth idea. You have maybe an old 401k IRA rollover you did, outside the plan. You've been thinking about it, geez, I think I should convert some of my money. I understand I've got to pay the tax today. So take a $100,000 example. I'm going to just, use a basic number of 25%. That's your federal tax or all taxes that you need to pay. So you take in the Dennis K. Burke plan, you take 100,000 of your 401k balance, you convert it. Within the Dennis K. Burke plan, in this case, the Record Keepers Principal Financial, they will take the 100,000 from your traditional 401k balance and convert it. You'll have another line item when you look up your balance online of 100,000. They, meaning in this case, Principal Financial Group, will not take the tax out of the converted amount. So what happens? At the end of the year, sometime in 2025, if you converted 100,000 this year, you will get a 1099 from Principal Financial Group, and it'll say you converted 100,000. And yes, you have to add that to your income. So if you made 85,000 salary in 2024, now you have an additional 100,000 of income. You're right. So that's a big discussion. It's not as simple as saying, let me just convert this. Why you do it is what we've been talking about. You're looking at it in terms of your own planning. You believe you've got a long enough time period to make up, quote unquote, that difference of tax liability you had to come up with, the 25,000. I would also encourage you to think about it too. We've not had high yield rates like we have in savings accounts in at least 30, 35 years I can remember. And that is, if you've got some cash in a high yield account, Capital One's got a good high yield, Marcus Bank, American Express high yield, you're going to earn 4.5% on your cash, which will help make up a little bit of that money you have to come up with to pay the additional tax. The other thing is, I think it's reasonable, that you're going to get, say, that 7% or so in a basic Standard & Poor 500 index rate of return on your investment. So on that converted amount, earning the 7%, if you had to come up with the 25,000, you're essentially going to, make up that difference within the 3-year period. Again, all hypotheticals, but that the reason behind conversion, which is becoming more and more of a discussion, is because I think people are very much in agreement. Tax rates will go up when you retire. The fact you can have a little more retirement income tax free really helps your adjusted gross income planning, helps your Medicare planning, helps a lot of things when you start to do the analysis. We also put in this slide about simplified pension, 403B, maybe someone in your family as a teacher, fireman, police, member of a union, maybe somebody is self-employed, consulting, has a SEP plan, a simple IRA. You convert those as well now. The whys, conversion is practical because, again, you feel long-term, it's much more beneficial to you to have more tax-free income. You also feel that over the window you have, maybe you're looking at 5 years, 10 years, you're going to make up in earnings and investments the tax you paid. I'll tell you another thought, right now, I've mentioned this to you on, some other seminars, the high yield savings are some of the highest they've been since the 70s. So, if you have a Capital One high yield paying 4.4, you have a Marcus high yield paying 4.4, 4.5, Amex high yield, and you have some cash savings in there, well, you're earning a reasonable yield on the cash savings. Yes, you're going to have to pull out some of the cash savings to pay the tax on the conversion amount. But unlike in the very near past, where you're getting almost nothing on your savings, at least now you're getting a higher yield rate of return. So, look at, again, the conversion amount discussion, just like you do comparing traditional 401k, get my write-off, versus post-tax Roth 401k, don't get my write-off. The taxes you give up over a period of time. This is a similar discussion here. So if you're going to convert 100,000 and pay $25,000 of tax, now the 100,000 will be whole, if you will, at your John Hancock 401k. They don't take the money out again when you convert. So the 100,000 will stay in your plan. You've just got it in your own calculation, figure, all right, I just had to give up 25,000 of cash. I'm doing this for a good long-term plan. But if I earn 8% of my S&P 500 fund on 100,000, that's $8,000. In theory, I'm going to make up that 25,000 loss in 3 years. You've got to do these calculations. And again, we do have some software if any of you would like to see that. So with that, take a look now at a little bit more on the Roth IRA, why you would convert. We've talked in different steps here today about, reasons why. I think number one, although it sounds really common sense, you're kind of looking at, where you're at in your planning. Age is a factor. Are you younger family? Are you a second family, maybe divorced, remarried? Do you have dual working house, only one income? I think all that affects the decision you make, on converting. But I believe that whole idea of getting more retirement income on a tax-free basis really will help your planning. We see this a lot, always asking, geez, the gross amount I'm getting every month is one thing, but the net amount is the second thing, right? So everyone's always looking to try to plan better to get a higher net amount, right, every month. Certainly the Roth IRA will help that. When are you going to need the money? Number two. Again, I mean, you may look at it, maybe there's an age difference, you and your partner, so you're saying, well, maybe one will continue to work while the other's not working. So we'll add to that person's account as a Roth. We don't need that person's money as quickly. Maybe you're one of the lucky that you have a pension. You're a member of maybe a school union, an old employee that has a pension. So it's easier to plan, right? So you're paying the tax today on a conversion isn't as big a deal because you don't need that money right away. Life expectancy, no one knows, right? Exactly. But you kind of take a peek at your family. My dad will be 90 this July. Great health. I mean, you have your hip, you have your knee, you have your shoulders, but I mean, his brain is real good. So, in my case, likely, I'm going to need the income a lot longer. And I would suggest probably a lot of you will as well. The issue comes up about beneficiaries. I want to dispel a little bit of the myth here and kind of number 4 related a little bit to 3 with the beneficiary. Sometimes people would think in a Roth IRA that the beneficiaries receive it tax-free and they also receive a tax-free income and they can just maintain the account as long as they want. They will receive it tax-free. It will escape probate, which is a big deal, a Roth IRA. But if you're a non-spouse beneficiary in a Roth IRA, just like a traditional IRA or a 401k, anyone listening has had a beneficiary IRA, they've been a recipient of that, you have to take it out now within 10 years. It's the same general rule in a Roth IRA. What's the big difference? As long as, when it's inherited, the person has over 59 and a half that passed, had it 5 years, then all the money, all the earnings come out of the Roth IRA tax-free. So even though you got to take a minimum retirement distribution out over the Roth IRA inheritance over the 10-year period, my suggestion would be, take that amount of distribution out and then put it back into your own personal Roth IRA. One idea, but I just wanted to bring that idea up and also define better for anyone. When you receive a Roth IRA, a beneficiary Roth IRA, call it, very similar to a regular 401k, inheritance, or a rollover IRA from a 401k. So all of these other issues you got to think about, assets you're going to use to pay the tax. We talked about you're going to have to use cash when you do a conversion. Anything related to rate of return of money. I would suggest to you that, regardless of what age you're at, when you do the conversion of Roth, I think you're thinking more long-term anyway, so probably going to stay moderately invested, which should help you make up that tax liability you had to pay a little sooner rather than put the money all in a fixed account or something along those lines. And 9, sometimes we'll run into people that have non-deductible money in an IRA. You've got to think about that when you do conversion, the deductible versus non-deductible portion. So with that, a couple questions came in. Can you explain again, Dave, when I leave a company and I had a Roth 401k, why I have to convert it to a Roth IRA? Good question, good pickup. The Roth 401k inside a plan does not have the same context as the Roth IRA, meaning the Roth 401k will still have to abide by the minimum retirement distribution rule inside a plan, inside a company plan. However, the way in which you work around that is take the Roth 401k balance, go to an individual Roth IRA and do the rollover. That'll work. That's the workaround, if you will, to not having to take a minimum amount of the Roth 401k.